Global news now. Jefferies has downgraded HSBC Holdings PLC, the London-based global bank, to hold from buy ratings, citing reduced upside after the removal of $8.5 billion of planned share buybacks from the third quarter of 2025 through the first quarter of 2026. The brokerage said that the buyback curtailment significantly diminishes the appeal of HSBC's investment case despite strong profitability forecast. Jefferies said that the planned privatization of the Hang Seng Bank, valued at $13.7 billion, is expected to be EPS neutral before synergies. The deal includes a suspension of buybacks for 3 quarters, which offsets an otherwise 4% accretive impact to earnings. While Jefferies described management's rationale for the acquisition as sensible, it flagged the timing and capital allocation as potential concerns. Revised estimates from Jefferies lifted HSBC's 2025 and 2026 adjusted forecast by 10% and 12% respectively, reflecting higher non-interest income and improved operating expense control. Analysts at Goldman Sachs Group Incorporated have cut their recommendation in euro-denominated high-grade bonds by banks to underweight less than 3 months after ending their overweight on the sector. Banks' bonds are now trading at even tighter spreads than the rest of the market, which leaves limited value in keeping a neutral allocation on the sector. This is the observation of analysts connected to the banks. And in Czech, inflation slowed in September to the weakest pace in 5 months, but domestic price pressures are likely to keep the central bank cautious about lowering interest rates. Consumer prices increased 2.3% from a year earlier, less than 2.6% the central bank expected for the month. This is according to readings from the Statistics Office. The slowdown was caused mainly by food items, while the cost of services maintained a faster growth pace at 4.7%. And just when the bank began to turn a corner from its $12 billion bond debacle, the Japanese lender is facing questions over how its joint venture became the most exposed to the First Brands Group bankruptcy. Well, the bank's Japanese trading house Mutsi & Co. are the biggest shareholders in Jamutsi Leasing Limited, while wholly owned by unit Katsumu Global extended $1.75 billion in trade financing to First Brands, the auto parts supplier that filed for Chapter 11 protection last month, was also sharing this report. And connected to that, the yen steadied on Friday, but is set for its steepest weekly drop in a year due to fast receding chances of a near-term rate hike, while the euro was rooted near 2-month lows as traders braced for France's 6th prime minister in less than 2 years. The yen edged up 0.2% to 152.7 for a dollar, but remained close to the weakest level since mid-February that it hit on Thursday. The Japanese currency is on pace for a 3.5% drop in the week. That's its biggest decline since October last year. This provides the need for an early start for trading.